the short squeezer. Hope everybody's okay with
Yeah,
what
looks
happened
great.
after the breakout.
Well, tomorrow on
Blakeout,
Fed Day,
Blakeout.
just a quick announcement. So Blake, Garrett, and I will be on the last hour for tomorrow after the Fed.
That's right. I'm looking forward to that too. The Fed technique, the Fed, will they cut by a quarter? Will they cut by half? Will they not cut at all? All the drama, they're going to cut by a
They're
quarter
gonna cut.
point. But
Yeah.
what will they say about the future? That's what I'm going to take your insights on and what you have to look at
Questions?
and the after effects of what the rate cut is, not just the direct report. What happens after? What's the spillover effect? Where the trades off of that? I'm
Did they
interested.
measure twice though? That's the question. Before they
Measure
cut.
twice, cut once. Like that. Measure
All right.
twice, cut once.
Anyway, see you folks. See you, Corey.
All right. Thanks,
Thanks,
Brendan.
Corey.
Thanks,
See
Blake.
ya.
We'll give a minute to transition over again. Welcome back. My voice might sound bad, might not. Depends on how you think about my voice. But we're here. We're playing the market breakout in today's session. Just give you a little heads up. And what most is pressing on my agenda is to make sure y'all are okay. In Wednesday's video, we talked about the market breaking out, this continued bull type thing. I've been, shaking my finger at the bears, mainly in the futures room, more so than the main room, but just getting this concept about the bearishness isn't really helping, isn't really working, and is to an extent being counter to making gains. It's a tough market, might not make sense, but that's when we go back to models, go back to structure, go back to higher highs, higher lows, take it outside of 2025. That's kind of my main thing in the bigger picture. Take it outside of what we're thinking about right here, right now. All the conversation with the Fed, AI, technology, blah, 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 which is first and foremost, throw that off the table and let's start talking about higher highs, higher lows as the market persisted when we don't necessarily remember all the news events that kept it going. So that's kind of my plea. This concept that markets rise, concepts of this bull breakout, what Gianni and I were talking about in some of our sessions. Of course, the game plan we do on a very short-term basis. I'm a very short-term trader. I do intraday trades with Blake and Tony. And our intraday play, I think Tim was on this as well. Saw y'all in the main chat room doing some range fades, S&P long off the low, just to kind of put the money where the mouth is type stuff. Look at the little timestamps on that. I'm just playing little small positions on equity shares. You can actually do pretty well doing that. Same logic on micros. And of course, what we're doing in the futures room is scalping. So scalping is just taking little bits of the puzzle and getting those in. So again, looking to go long off support shelf low. It is a range day. It is divergent. Divergent? There are divergences. We've already gone long support bounces from this 2406. That's for trading support shelf for longs. Of course, if it breaks, again, this is not a hindsight hee hee ha ha. This is a given what we have, the day is a little bit more range consolidation. That means we want to be playing long off of lows. And if the market can rally, we'll be short off of highs. But again, real time going forward, long the 4, the 5, target the 70. It actually got hit not too long after that, 4 minutes. Again, scalping futures is for the brave. You can make a lot of money that way or lose it. Maybe trading calls or trading some shares might be better for a lot of other traders. But long scalp play, again, other traders got the play. And +4, same type of logic. Do it again, 6 to the 10's a +4. You can just looking at the timestamp here. Other traders doing the same logic, +4, +3. Kyle's doing both markets, Jacob as well. This will be in tonight's report, tonight's game plan. Just getting little handles is all we can do. Closing the trade for about a +6. Again, this is as we go. Peter had the same type of trade, and the market gave us that. So that's what the play was. Live, real time, under conditions of uncertainty, long off the support shelf, right? Again, all the trades come from that, whether you're trading IWM, trading spiders, trading micros, or the like. This is just a good example about how we like to scalp our account, trade our account with the bigger picture in mind. And there we go. So anyway, long plays off of here, long off the lows, and that was it. That's all we did today was go long off the lows in the futures crew. So bold holds is where it's at. But we're not going to talk futures beyond what we just talked about in the main room. Because the main room is for the big pictures, the swings, and we'll start with that. Yeah. Sleek Cobra, my voice is hoarse from looking at this one. Actually was. I was. I can tell you lots of stuff I did. I'm more interested in getting y'all caught up on the markets, caught up on the trades. But no, I had a really good time in Alabama. Family, friends. Got to see Blues Traveler. I've had this trip booked for about 2 months. And my favorite band, I was telling Blake in the Futures Crew, y'all know this. I love Blues Traveler. I'm a harmonica player, fast harmonica solos like John Popper of Blues Traveler. And he played in Albertville. So I actually caught with some friends a Blues Traveler concert on Friday night. And that was kind of I'd say the highlight of my trip, but also went ziplining, saw my, friends, family, and there was a lot I should say my family was the highlight of the trip, shouldn't I? But I don't know, zip lining and John Popper, of course, doing some trails in North Alabama and just, seeing people I haven't seen in a few years. Very good. But I am back with y'all. And the market, somebody said in the future, you should travel more often. The market was ultimately bullish and trading, very bullishly in that play. Oh, what I was finishing up just a couple minutes ago. Take away the headlines, take away the news, take away the expectations, take away our feelings, take away our emotion, and let's just play structure. So, what structure to me is when markets are rising, they tend to keep rising. When markets are falling, we can actually see the bear side of Dow Chemical. They tend to keep falling. And some other plays on the downside. Ooh, back over here. We're going to have some new stocks to short, Accenture and UPS, just to name a few. Remember, it's not all bullish, not all bullish, not all bullish. And Dow Chemical and Accenture there. But generally speaking, the market being bullish, we want to come behind that and trade in the direction of the trend. And if a trend is in motion, it's not always in motion, right? Disney is a stock that is not trending. So we want to be short of Disney off these range highs. We're playing on the put side, put or put spreads. Target's going to be that 102, 103. Again, successful trade came out here. Other successful trades have come off the longs and the shorts of around 85 and 120. So if a market is not trending, if a market is, let's say, sideways, these are our candidates sideways: Linde, Verizon, Costco, Triple M, UNP, and Qualcomm. We want to go fade those like we faded the intraday chart of the equity futures. Right? You want to fade, which means go long off the lows. And if the market goes back to the high, we want to fade off those short. But if it's trending, and a lot of stocks, I'd say a lot, not a lot, not a lot, I should say not a lot of stocks are trending. If they are trending, you want to trade in the direction of the trend. Just to name a few would be Broadcom, Google, and Oracle. So when I'm doing my trades, you can tell I'm kind of excited. Um, but I like to trade in the direction of a bull or a rising market. I like to buy pullbacks that can include calls or call spreads or just, again, long shares. There's nothing wrong with going long 50 or 100 shares of a stock. I know Professor does that sometimes as well. So a couple hundred shares, not a difficult thing to do. Going long a call option, again, maybe a little bit better. Going long a call spread, perhaps even better. Going short a strong stock getting stronger, not a good strategy. Whether you shorted the shares, whether you bought a put, or whether you bought a put spread was not relevant because you probably lost money going up against strongly trending stocks. That would include Broadcom, that includes Google, and Google especially. Anybody short Google, do not raise your hand. We just don't want to do that in the context of a trending stock. So don't go up against a trending stock. It doesn't matter what you do. You're going to lose money more likely than not. Go in the direction of a trending stock. Try to do so on pullbacks. Again, retracements, entries, or executions, putting on a position when the market has pulled back to a rising average. I know Gianni does, and Blake to an extent would actually execute long on a breakout. And you're like, why would you do that? That is absolutely insane. Insane, but profitable and better than going up against a strong stock in a strong sector with a strong trend. So beyond that, I want to make sure like good. Hey, Charlie, good to see you. Hey, Laura, yep. Two Stillman, there you go. Yeah, two Stillman. Yeah, good harmonica player. Two Steelsman. Let's see who else. Sugar Blue. The other harmonica player, I'd say that's on par with Popper would be Sugar Blue. In fact, John Popper looks up to Sugar Blue. Two Steelsman and Charlie, was it Musselwhite? Lee Oscar and lots of good players there. Okay. Back in the chat. Yeah, David said imagine they cut. Well, the Fed's going to cut. And this is something that I kind of parlay that conversation into what we're doing. So let's talk about the rate cut versus not. So who believes, I won't put this in chat, but who believes the Fed's not going to cut? Who believes? Anybody? I'll put this in chat. I will put it in chat. And I want to kind of get this in chat. This kind of gets you thinking why I trade, and how I discuss the trades with y'all. So I want to know who amongst you thinks the Fed is not going to cut interest rates tomorrow. Let me know in chat. We got 2 votes for will cut. Keep going. Aha, Craig said they won't cut rates. Let me parlay it from a trade standpoint, not from a prediction standpoint. Anybody else jump in? So Laura said they will cut. Yeah, Laura said they'll cut for sure. So Craig says they won't cut rates. Well, hey, Linda, good to see you. Laura said we'll cut, we'll cut. Rich says no cut. Okay. So aha, see, this is what trading comes down to. This is what I want to discuss. It's not about predicting future. It's not about being right. I said, he said, she said, I made a good prediction. Look at me, pat me on the back. What does Tony say? Look at me, I'm standard. Trading is not a game of that. Not a game of I told you so's and hee hee ha ha's. Trading is a game of putting the information together. I would even make it more simple. Trading as a game, I call it a game. I like games. Otherwise, it's war, right? I don't like to see the market as war. I see it as a game. I see it as fun. Getting information, which is, I mean, it's kind of hard, right? Gather information, assessing the odds. So calculate the odds. Right? Not perfect, but best we can. And determine when to go with the odds, right? Or say are. Look at me being all English professor. Data are wrong, information are wrong, and we go against. So trading intraday futures, trading of swing trades, what the Fed's going to do, calculation of what they're going to do, and of course how the market acts is specifically down to this. What are the odds? What's the info? When do I go with it and when do I go against it? And there's a really, really easy way to figure out what the odds are for the Fed rate cut. There is a 90% or 96% chance they'll cut. So that's set in stone. Ain't no, not even Warren Buffett, right? Not even Warren Buffett can have insider information. There's a 96% chance they cut by a quarter basis point. There actually is a 4% chance they cut by a 50 basis point, and that's not going to happen. So trading to me comes down to the following. All trades, all bets are sort of like this. Wanna bet? So what happens if they cut? Well, the market's already gone up. We already expect that. Maybe nothing. Maybe the market goes flat. No big deal. But want to bet that they don't? If they do not cut rates in that 4% chance, the market is going to go down, and it's going to go down very, very rapidly. So let's talk about the 4% chance the Fed does not cut rates. The S&P, maybe by the end of the day, will be at 6,500. You think I'm kidding? I'm not. I ain't kidding. And the volume profile in terms of my game plan will be down from 66, basically 6670 or 6700, down under 6500. In other words, we'll go from yellow to yellow. So in the 4% chance they don't cut, we're looking at the market down here by the end of the day, or maybe by the Thursday or so. But that's a 4% chance of happening. You get a lot of money if that 4% comes through. Play the put spreads, limit your risk. But that's probably not going to happen. So if the market, if they do not cut rates, the market crashes and you will stand to make a lot of money, lots of it, hundreds of percent on your puts and subsequent gains on your futures, probably more than that, so on and so forth. But there is a 96% chance you're wrong and that they do cut. Doesn't guarantee the market's not going to fall, right? You could actually make money in that scenario. But if you're betting on the market crashing, you may or may not know it, but you're betting on a 4% chance of success. And in fact, I would even say you'd be more screwed if that happened. Why? Because in the 4% chance, they cut by a quarter, 50, right? 50 basis points. And that will surge the market straight up because the market is not pricing in a rate double, right? A double rate cut. That's what Brandon was saying, right? Measure twice, cut once, measure twice, cut twice. So if you play that percentage, you'd actually probably rather want to play long. And why would you rather play long? Because in the event they cut by 50, there really isn't an upside target. See, I can give you downside targets. I can give you, moving averages and bottom of the profile, and I can give you all those things. Here's the thing I cannot give you as a trader. It's what Gian and I were sort of joking about when we had our session. Give me an upside target. I say there is no upside target because that's something that hasn't been factored in. A quarter basis point is factored in the market. We know that it's going to happen. Disagree, do something with your trading account, right? Play a put, play a call, do something. But I've always been better playing with the odds than against it. So if you're looking for a major move in the market, you need to bet that they either A, will not cut, which case we go down, or that they double cut, in which case we surge up. Neither of those scenarios are what I would say plausible. So if you're betting on that and it comes Thursday, the Fed's cut by a quarter basis point, then again, the model has worked, the expectation has worked, all the fancy mathematics, all the fancy conversations, all the TV shows, and all the sessions here on TheoTRADE, whether they cut or don't, all the breathless commentary has resulted in what was pretty much staring us in the face. They're going to cut by a quarter basis point. Now, again, that does not guarantee what the market will do. And therein lies the problem. It's what Don says, and I totally agree. They can give you, right? The companies can actually hand you the earnings report. So I can tell you what the Fed's going to do and make a prediction all you want. The Fed's going to cut rates. But what is the market going to do with that? And it's not even, the whole discussion is not whether they're going to cut or not. It's about what's the next event. I think Brandon was discussing that very, very well. So it is a fait accompli. They will cut, gonna cut. But the market will be pricing in and moving what they say about the next cycle. So what is the next cycle? Is the economy, are going to make comments about the economy's really bad, so we're going to cut, or the economy's really resilient, so we're not going to cut, or inflation's a big deal. So we'll be watching, again, Don and Blake, Brandon, Gianni, I believe, will be on during the Fed conversation, the Fed meeting, and after. So we'll have live commentary with the team here in TheoTRADE that will walk you through that. So that's my thought. Now let's parlay that conversation into the stock market. Parlay, right? So a stock that is rising. So this kind of gets into my thinking. So a stock, let's put it in green just for funsies. So whatever the stock is, whatever it is doesn't matter to me. But what matters to me is that a stock would have good, rising, improving fundamentals, which has to do with earnings and cash flow and, again, things that Brandon would discuss. So what are good, rising, improving fundamentals? Good, rising, improving fundamentals would be this. Not that, because that's S&P futures. Something like Microsoft. So I don't know about you, but again, I want to get this in the same thinking of this 96% chance of cutting rates as a pretty a good indication of mathematical certainty as we can get, 96% chance, is the same level of mathematical certainty that rising sales per share, rising free cash flow per share, and just regular cash flow, book value per share, earnings per share, dividends per share, net profit margin, and financial ratios going down, like long-term debt capital going down. I don't care if you're Warren Buffett. That's good. That's green. That's bullish. So I want to use that same type of confidence to have a strong base of a rising, improving fundamentals, which again forms a base. So that is going to be combined with a chart. So in this example, or the next layer or level, rising uptrend in price. Right? Just simple, nothing hard. And an uptrend is simply higher highs and higher lows and higher highs and higher lows. So now it gets back to that same conversation about 96% versus 4. Now, what makes a market are the people that bet against it. Well, I believe they're not. That's what makes a market. And sometimes it does not happen. Again, it's all odds and probability. But there is a better percent or better probability that the future of a rising stock, rising fundamentals, and a rising chart, future. Again, that's the same type of mathematical probability, just a little bit more difficult. So that's what I asked the question, who is going to be going short Microsoft? Or who's going to be going short Google? Or even for that matter, Meta, NVIDIA, GE, AutoZone, all those types of trades. So GE is a good example. And the example would be rising fundamentals is a fact. A rising uptrend in price is a fact. So, of course, the trades to me are going to be long. But we're going to build trades off of facts where we don't know the future. We only have probability, we have risk, and we have targets and the like. So a trade, if you have strong rising fundamentals, if the chart's going to keep rising, let's be bullish. Let's find a way to buy pullbacks, my method, buy breakouts, Blake, Gianni, and maybe others, or just in some way avoid, stay away from betting against a stock. So that will help you, especially if you're a new trader, new to TheoTRADE. If you're constantly taking trades that have a 4, 5, 10, 15% chance of success, and you're not successful, they hit every once in a while, and it's really exciting, and you get a lot of money when they hit. But more than not, your short or contrarian or counter trades are not going to hit. And that for a new trader can lead to frustration. And I would say it's frustration because whether we think so or not, we're actually betting against fundamentals, rising uptrends, and models that suggest a trend continuing. So that is there. Yeah, I think, well, Peter, I kind of think so too. Peter said 50 basis points could scare the market as well. Like, oh, what does the Fed see? And again, that's probably not going to happen. Yeah, Peter said, yeah. So what is your projection? Well, I mean, the projection is 96%. So if you disagree with that and take an opposite position, but that's what makes markets. And I think that's a good thing that we have competition. It's a good thing we have different viewpoints. It's a good thing. It's not a bad thing at all to be contrarian or take a low probability bet. But know what you're doing. It's the same conversation about taking like a strong horse. Let's just say they're at a racehorse track, and there are two horses, a strong horse, I won't draw it, but a strong horse and a weak horse. Let's say with a 30 win record and like 2 loss. And you're up against a weak horse with a 3 wins and maybe 25 losses. So let me sort of ask. We don't think about this in trading, right? Trading is a little more nebulous or emotions and things like that. But who in TheoTRADE, he could be honest. Again, that's what makes a market, right? Makes a market by doing things differently sometimes. But if you want to win, if your goal is to collect money, or whatever the concept, sports team, or things like that. If you don't like the word horse, then it'd be sports. It'd be like the better baseball team, the better soccer team, the better football team, so on and so forth. So who in TheoTRADE, kind of get y'all's attention here? This is long-term stuff. How many of you, honestly, would bet on a strong horse versus betting on a weak horse? Let me know in chat. And for clarity, those of you who don't know me, I'm not trying to lead you in a direction. What I'm trying to do is gauge the audience. Photo guy got it. And actually, that's again, I'm not trying to trick you up. I'm not trying to be silly. It does depend on the odds. It does depend on that. But let's say if you win, it's 2 to 1. And here, let's say, is 20 to 1. So what that means is for every $100 you put down, to me, this is what trading is, right? So for every $100 you put at risk, buying, in this case, buying a call, buying a put, right? That type of thing. Every $100 you bet on that team, that will turn into $200 right here or $2,000 right here. So some traders can be lured by this. Well, 100 to 200s, not that great. But 100 to 2,000, that's pretty good. It's the duality of the odds. In other words, you have a, let's say, 95% chance, or 90 for that matter. Actually, 95 is pretty good, versus 5. So does that change your perception? Does it change you thinking about, well, or flip it the other way? I have a 95% chance of losing $100. I have a 5% chance of losing. You can flip it either way you're comfortable. And again, this stuff hits. 5% stuff hits. Low odds gambles hit. They pay. Sometimes they pay more than we think they might in the market. And it's neither, there's nothing moral. It's not moral. It's just mathematical probability. Which one are you? What's more comfortable? And for me, in a 20-year, 25-year career doing this, I've done both. I've played for home runs. I guess the other way to call it be home runs versus singles. Singles. Nothing moral or ethical. It's just what's better for you. And some of you might be, home run type traders, and you're going to play options. You might play different strategies, and that's completely fine. There's a viable, profitable career out of that. But for most traders, most people, again, not everybody at TheoTRADE, not everybody in general, but for most people, taking the better bet leads to longer term, I'd say, profits, mental state, happiness, joy, less frustration, things like that. So anyway, just different ways to think about markets, or think about odds, or think about, earnings reports and things like that. I will bet on the side of the odds. Almost every time. I've got to have a really compelling case to go against the odds. And more times than not, I just don't. I don't have a compelling case to go against the odds as they are stated. So that would produce trades like this, that when the market is at session lows, right, you can think about range. Again, I do not have hindsight and foreknowledge when we're live trading. None of us do. We only have odds and probability. So again, this is why I talked a lot in the futures room, and I think Cross posted, because I was getting you long, scalping you long, trading you long off the S&P and the Russell. Why? Because I was reading and hopefully explaining to the team how to do this on your own, reading the price action, reading the balance and supply demand, reading and identifying a range day. And from a range, we want to trade long, again, calls, call spreads, micros, shares, futures, lots of ways you can, do the actual trades from a support shelf. So the odds, I think I put it best here. Everybody on long support. Yeah, so the odds of the rally would be stronger than the odds of a breakdown. So again, I don't know the future, but we're having the same conversation about would you rather play for, let's say, a 70 or 75% chance of a rally versus a 25% chance of a break. And if it breaks hard. And we can do, again, Blake and breakout type trades. It doesn't mean you can't do anything after that, but the next move of the market, this is the now, this is the future, had a much stronger probability of going up. So again, long type logic, capturing small scalps, other traders playing bullish, Jay's long every market, Jacob's holding, Kyle, so on and so forth. So again, this is the timestamp as it goes, just, talking intraday Peter, and of course the range day fades were correct, and even more so. But that's trading in a nutshell to me. And I even said that the odds of going short, you're about to get your head ripped off. I mean, I can be direct sometimes. You're gonna get your head ripped off, and sure enough, the head was ripped if you read the market probability incorrectly. That's all we can do, right? Everything comes down to probability. Everything comes down to an entry. It comes down to an exit. So whatever you're doing in your trades, with all instructors and me included, we want to come down to. We want everything to fix down odds of success versus failure, and the potential profit versus the potential loss on a loss, or loss on a loss. So I don't know what the Fed's going to do. I pretty much tell you what it is. I can stick my neck out, right? I'll stick my neck out, y'all. They are going to cut rates by a quarter basis point. Cool. Wonderful. But did it wrap a trade around that? And to me, wrapping a trade around things comes down to a setup, which means an entry, an exit, which is either a stop or at target. Now, keeping it simple, on a range fade trade, the entry is at the support shelf. So support price, we go long. Divergence makes it better chance. The stop will be under. So the way a trade setup looks is like this. The stop is going to be under. The target is going to be the prior high. So that sets up a little risk reward. So hopefully it does this, which means goes off to the high. And once that happens, that's when I wipe my hands clean. The target got hit, the stop got hit, the target was done. We got in at the correct spot, did micros, did futures contracts, and etc. And this is the future as it plays out. Boom. And to me, that was all the trade was worth, but it kept going. But that same discussion is going to play off the big picture. So again, not going too far over my skis, but that's what we're doing on any particular trade. So if we're looking at things that are range bound, we want to go long off support and short off highs for good risk reward. Right? Same type of logic in the S&P, which is actually much higher now. That would be the case if we're trading swing trades sideways, short from above. Disney would count in that too, and long from beneath. XLE would count in those criterion or those setups. But trending stocks have very, very, very different probabilities, characteristics, structures, and ways we trade them. So we don't want to take a hammer to every single type of setup or every single type of job. If you want to cut down a tree, you don't use a hammer. If you want to put a nail in the wall or take a nail out of the wall, you need to use a hammer. You don't want to use the same trade, range, support, shelf, low, or a bull flag in a trending market when there is not the right conditions or criterion. So that's what we're trying to do. We're trying to, number one, assess, are we trending? Yes or no? And if it's a strong trend, even better. It's kind of, mealy mouthy, wishy washy. We don't really want to trade that, right? You want to trade where you have the edge. Makes sense to me at least. And the edge is going to come, the probability is going to come from correctly assessing the odds. And the odds to me are coming from whether we're trending, stock market, obviously technology and other things, financials are trending. And we're going to trade that one way as opposed to something like Disney, which we remain short on Disney, but not short because we don't like it and not short because we don't like the stock because we've made money. We are, or I say we, a lot of us are trading Disney from the short side of the market because the odds favor coming back to the mid because we've already made money here. We've already made money here, right? You can get little small profits like I like to do or trade for something larger. So we are not going to be bull flagging Disney. This is a conversation I like to have because Disney is not trending. It sure does look it. Again, context is going to be key in all the trades we take. Context. This is not trending. It's a range. So back to the intraday chart. Again, this is not trending. It's a range. I mean, obviously we want to, try to assess this before it happens, and that's the goal. The goal is not to predict. The goal is not to think, right? The goal is not to, put our biases to work. It's just to assess, are we ranging? Are we trending? If we're trending, we do these things. If we're ranging, we do these things. So to me, on the intraday chart, get day done. On the swing account, just play the position until the targets hit. Yeah. Casino Dave, I like that. Casino Dave said there are old traders and bold traders, but no old, bold traders. I like that. Yeah, and I'm with Rick. Looking back in the chat for a while, jump. Yeah, Mark said the strong horse. Rio said strong horse. Robbie said strong. Tim said strong. Depends on the odds. That's exactly. Usually strong horse, strong horse. Rodney, strong horse. Yeah. Well, if it is, I mean, that's the other thing about being in the photo guys, right? So what if they actually can add out, but what if there's a 5% chance of a win, but instead of 20 to 1, let's say it's 2,000 to 1. So what do you get there? You get $200,000. Then you're kind of playing a game show at that point. You have you got a 5% chance at $200,000. You have a 95% chance at 100. And the odds can be so in favor. We might want to call this, or you see people call this pot odds. Not to go down that route, but if the pot odds are like, well, 5% chance of getting 200,000, hell, get in there and buy you some lottery tickets. It actually is worth it to do that type of thing. So again, I'm not shaking my finger at you saying, don't you dare go 5%. You're crazy. No, but make sure the pot odds are good and make sure you understand the risk and make sure you're willing to deal with the consequences. And the consequences would be out of 100, this is not fake. Okay, this is real, y'all. The consequence of playing a 5% win rate out of 100 trades, 95 of them will fail. But on the 5, if you're losing, say, $100 and you get $10,000, well, that's a viable strategy. But this is the domain of the professional traders. Why? Can you take 67 or 84 trades in a row, or I'd say maybe 36? 36 trades in a row. Loss. Boom, negative 100. Boom, negative 100. So, can you do that? Most people cannot. A professional can because they know. They've done it, they've modeled it, they've tested it, that out of those 5 trades, they get a significant amount of money. And it actually does become viable. But can you get stopped out 36 times in a row and then put on trade 37? A professional can do that. A new trader probably cannot. So again, psychology plays into the numbers game more than we like to admit, I think. So my answer is let's play high probability unless there is a very, very, very compelling reason to take the long shot odds. And again, my audience, who I speak to is mostly new and developing and on your journey to become a professional trader. I'm not speaking to people that are 40 something years in the business, right? Y'all kind of got this. You don't need to be whatever. So I'm speaking to newbies. I'm speaking to people that are struggling and wanting to be successful. And my solution would be make sure you understand the odds. Make sure your feelings are not getting in the way of the odds. If the market crashes, I'm going to make $1 million. Yeah, you might, but it probably isn't going to crash. So let's find a way to get long. I don't know, something, but separate feelings and emotion from statistics and math. And that is boring. It is, but I would lean on the side of boring, consistent, and profitable over exciting, yeah, and fun. Lotto trades are fine. Nothing wrong with lotto trades, but just know what you're getting into. Tony is up next. Where is Tony? I think it's Tony. Is it Tony? Never tell me the odds. Never tell me the odds. I think we have Tony. Make sure Don's in here, but is Tony? I was guessing Tony's up next. Let me triple check because I've been out of the office. I've come back from vacation. There's Tony. I thought so. I was like, wait, no, Tony. But to me, a range session, long off lows, short off highs, but Fed's going to be the main determinant of what happens tomorrow. But Tony, are you ready?
Yep.
All right. All right. Take care. Be safe. We're talking odds, probabilities, range consolidation, Fed, and long shots and lotto trades, risk reward, and all the fun stuff.
Right on.
All right. Take care. We'll good to be back. Well, good to be back with y'all. Tony's up next, and we'll walk through the Fed again. Everybody's on tomorrow. Don and the crew will be on for tomorrow for your Fed meeting. So Tony, take it away.
All right. What's going on, everybody? It is the day before the Fed.